Hi, and welcome to this week's market presentation. Looking at the latest price evolution over the past week, we note further decreases across the board impacting crude oil, natural gas, and electricity markets in Europe. The decreases were notably felt across crude oil markets, as one might expect, with the decreases across natural gas and electricity markets much more modest over the past week. Latest news. Looking at the latest energy news, we see that the de-escalation between the US and Iran has begun unlocking the oil supply that had been halted due to the lack of commercial transit through the Strait of Hormuz. As part of the negotiations, the US has granted a 6-day waiver for Iranian oil exports, even to the US for the first time in decades, increasing the global supply of crude oil. As the Strait of Hormuz gradually reopens and tanker traffic moves towards normalization, we are seeing crude oil markets relax significantly. Now, we do continue to see tensions across the strait with Iranian drone attacks against commercial vessels over the past week. That is certainly putting in jeopardy the stability of the ongoing ceasefire and the prospect of a further reduction in transit versus what we've been seeing over the past week. Nonetheless, crude oil markets globally have seen future prices fall below pre-war levels over the past week, with Brent now near the $72 a barrel price level. The massive supply influx has flipped the Brent spread into contango, a clear technical signal of a near-term oversupplied market. Now, market prices are still seeing slight geopolitical risk nonetheless, as the ceasefire negotiations remain fragile. But beyond that, the physical surplus, if we do see a return, is currently very much weighing on crude oil markets. In Europe, a record heat wave over the past week with temperatures across Europe as high as 10 and 12 degrees above seasonal averages is pushing the European power grid to its limits. Soaring cooling demand has pushed electricity consumption levels to levels typically seen during the winter. Low wind power generation coinciding with peak evening demand added to the stress on the system and the increased demand for fossil fuel power generation. Additionally, the record heat also sent river temperatures in France upwards, forcing major French nuclear power cuts as a result. Spot prices have spiked to multi-month highs across Europe, with intraday prices in Belgium at times exceeding €1,000 per megawatt hour. Germany hitting a new record high of €615 per megawatt hour. So far, French nuclear curtailments have peaked at around 6.4 gigawatts or 10% of capacity, with the risk that another prolonged heat wave could push curtailments even higher. The increased call on gas and even oil-fired power plants to meet demand also adding to overall generation costs. Lastly, for the latest news, the political turmoil in the UK with the resignation of Prime Minister Keir Starmer has hit the carbon market, with now expected delays in the linkage between the EU and UK carbon markets, with uncertainty as to who will succeed Prime Minister Starmer and what would their policies be moving forward. A key EU-UK summit is scheduled for July 22nd has now been postponed, with separate calls from on 12 EU climate ministers to discuss a possible joint stance on the ETS to try and assuage markets. UK carbon allowance prices fell sharply on the news, with now the expectation that we could see a prolonged delay towards linking both markets, or even a potential reversal if the next prime minister has different policies in mind. European allowances, on the other hand, remain resilient, supported by bullish power fundamentals, and continue at elevated percentiles. Weather. The latest weather forecasts are now indicating cooler weather across most of Europe over the next 7 to 10 days, which will be a sigh of relief for those in Europe, which had been facing record-setting heat over the previous week. Nonetheless, looking further ahead, it remains to be seen whether the cooler weather will persist or whether additional heat waves will hit Europe over the coming couple of months. Precipitation is expected to pick up through the beginning and middle of this week before easing off again over the beginning of the following week. The outlook for the Nordic region has brightened given the greater precipitation, but the hydrological balances remain in negative territory. Wind speeds, on the other hand, are expected to ease through the middle of this week before picking up again slightly at the beginning of the following week. Crude oil and LPG. Looking next towards crude oil prices, we note the further drop in the market, with Brent crude prices for the front month falling further nearly 11% over the past week. For West Texas crude, we've seen a similar decrease of 10% over the past week. Overall, a bearish price evolution across the forward curve. Now, it remains to be seen whether progress on negotiations between the US and Iran will allow for crude oil flows through the Strait of Hormuz to normalize to pre-war levels, but markets certainly feel optimistic that that return will happen soon. Crude oil stocks in the US have continued to fall over the past week, as even though optimism in markets has decreased the price pressure on market prices, we are still not yet seeing the normalization of exports out of the Middle East. And as a result, we're still seeing the US pulling from inventories to meet the current supply deficit. Natural gas. Moving towards natural gas markets next, we note the slight decrease in the price level over the past week. The front quarter now down 3.3% on the week, the front year down 3.1%. Following the sharp decreases in the market as the ceasefire and peace agreement between the US and Iran was signed, we're now seeing prices starting to stabilize, as even though the outlook has brightened, we still see concerns over the return of LNG exports through the Middle East. Storage levels are another point of concern for European gas markets. And while storage inventories have continued to increase over the past week, we do see the rate of injections falling behind that of last year, with the deficit versus 2025 now at just around 50 terawatt hours. The injection rate now still remains in line with the past 13-year average, but nonetheless falling behind last year's levels. Overall, looking at total demand, we've seen an increase over the past week, in part driven by higher demand from the power sector in order to meet that surge in cooling demand as a result of the weather. Looking at total supply, while remaining at the bottom of the range over the past 5 years, has seen a slight uptick over the past week. The uptick in total supply has been driven by a further increase in Norwegian and UK gas flows to Europe, which have now hit a 5-year high. On the other hand, LNG sendouts saw a dip over the past week, now falling once again close to that past 5-year average. Investment funds finding more optimism following the memorandum of understanding between the US and Iran and the prospect of a return of Qatari LNG export within the coming weeks has seen a sharp decrease in the level of net long positions, with market participants selling off their positions and seeing an increase in short positions by market participants. Coal. Looking next at coal prices saw a further decrease over the past week. The API2 index for the front year down 2.1%. The increase most noticeably felt in the API4 index, down 5% over the past week, and in a more clear bearish price evolution over the last few weeks. Coal prices in Europe are certainly being weighed down by the drop in natural and oil prices. And we're also seeing weaker demand from the power sector as a result of still strong renewable power generation. Another factor, however, complicating the picture for European coal markets are the low water levels along the Rhine, limiting the coal arrivals from ports to German power plants. Over in Asia, the still strict safety inspections amongst Chinese coal mining operations continue to increase import demand out of China. EU and UK emission allowances. Moving next toward European and UK carbon allowances. European allowances remain relatively steady over the past week, but nonetheless still at relatively high percentiles and a still bullish price evolution over the past few weeks. On the UK side, we've seen those come down, as mentioned earlier, due to the political turmoil in the UK and the added uncertainty over the direction of the UK government policy regarding the linkage of the EU and UK carbon markets. Power sector emissions in Europe surged over the past week as we saw surging cooling demand in Europe, and it necessitated an increase in fossil fuel power generation to meet that spike in demand. As a result, we saw power sector emissions going from a 5-year low to now closer in line with the past 5-year average. Investment funds have seen a slight uptick in the level of long positions amongst the EU market, while the UK market has not yet seen much movement. But as we get more data and as markets digest the impact of the resignation by Prime Minister Keir Starmer, we're likely to see additional movement on the UK side of the market as well. Electricity. Lastly, looking at electricity markets, electricity prices in Germany saw limited movement over the past week, slight decrease, particularly for the front quarter now, of a decrease of around 1.7 percentage points. The front year down just under 1.2% on the week in a relatively stable price evolution over the past week. Electricity prices across other European markets following a similar price evolution, with prices seeing more limited movement over the past week following the sharper decreases that we saw earlier in June following the agreements between the US and Iran to end the active portion of their conflict. Over in the Nordics, we've seen the brighter outlook for the hydrological balance ease some of the bullish pressure on particularly Norwegian EPAD prices, but nonetheless, Nordic power prices remain supported by the still negative balance. Looking at total grid demand, we've seen total grid demand move up to a 5-year high due to weather conditions. On the supply side of things, non-dispatchable demand remained relatively steady over the past week, slightly below the highs that we saw in 2025. On the other hand, as we can see here, the increase in demand ended up being primarily met by an increase in dispatchable supply, particularly from fossil fuels. If we look at non-dispatchable supply, we see that while solar power generation surged to a new record high with output above 1.5 terawatt hours per day, that increase was certainly weighed down by the decrease in wind power generation, unfortunately coinciding with that surge in total electricity demand in Europe. In terms of dispatchable or residual load, we see that sharp increase in fossil fuel output from 5-year lows to now in line or just below the past 5-year average. The increase in demand for fossil fuel power generation also being added by the decrease in nuclear power generation across Europe, particularly in France, due to the aforementioned power curtailments as a result of the higher river temperatures. And lastly, looking at guarantees of origin, we note an uptick in the price level, up around 12% for the 2026 year of production, around 10% looking at 2027 and beyond. Overall, we're still noticing a bearish price evolution, largely driven by the decreases seen in previous weeks, although with the uptick that we've seen over the past week, we're currently be looking at a change in the observable trend over the last few weeks. Overall, guarantees of origin are certainly finding support in the Nordic hydro deficits, although that outlook has brightened as of recently. On the other hand, adding some bearish pressure on the market and keeping prices still on the lower end is also the expectations of renewable power generation capacity additions as renewables take the lead in power generation additions this year. That covers this week's market presentation. Thank you for joining.